$4.2 billion moved quietly, then silver exploded past $70. By late December 2025, the global financial markets witnessed a phenomenon that defied the conservative projections of nearly every major analyst house, as the price of silver shattered its historical ceiling to trade past $70 per ounce. This was not merely a speculative bubble or a fleeting moment of irrational exuberance, but rather the culmination of a structural realignment in how the world values tangible assets against a backdrop of geopolitical fracture and industrial necessity. For years, the silver market had been characterized by a quiet accumulation of deficits, a sleeping giant that many investors had engaged with only tentatively, but the events of late 2025 signaled a violent awakening. To understand the magnitude of this move, one must look beyond the surface-level charts and into the plumbing of the financial system, where a specific recurring figure, $2 billion, began to flash across corporate filings, market capitalizations, and industrial forecasts like a distress signal from a system under immense pressure. The narrative that has emerged is not one of a single rogue trader cornering the market, but of a hidden buyer that is actually a composite of massive institutional liquidity, strategic corporate pivoting, and price-insensitive industrial demand that all converged on this specific valuation threshold simultaneously. This rally, which saw silver gain over 140% in a single year, outperforming gold, the S&P 500, and even Bitcoin during the critical holiday trading window, appears to have been engineered through a perfect storm of supply weaponization and capital rotation. It is a story of how the old world of physical commodities finally wrested control from the paper markets, driven by a desperate scramble for the conductive metals that power the modern economy. To deconstruct this event, we must first examine the financial signal that alerted astute observers to the coming squeeze: the sudden mobilization of $4.2 billion in liquidity by one of the most aggressive players in the corporate treasury space. Strategy Inc., the company formerly known as MicroStrategy, has long been viewed as a proxy for digital asset adoption, yet in the fourth quarter of 2025, it executed a maneuver that signaled a broader shift in capital allocation. The company announced the consolidation of its at-the-market offering programs, specifically targeting the sale of up to $4.2 billion of its variable rate series, a perpetual stretch preferred stock. While the stated intent involves general corporate purposes and the acquisition of Bitcoin, the sheer scale of this liquidity event, $2 billion, coincided precisely with the moment institutional portfolios began a massive rotation from digital assets into hard collateral. This capital raise was not happening in a vacuum. It occurred as the company's stock price had surged over 165% in the past year, trading at a significant premium to its net asset value. However, the market began to question the sustainability of paying such premiums for digital exposure when the underlying asset, Bitcoin, began to falter below $90,000 during the December trading sessions. The $4.2 billion figure thus became a symbol of the Great Rotation, a massive pool of capital that was effectively seeking a home in a chaotic market environment. It represented the liquidity that was available to move markets, and while Strategy Inc. remained committed to its digital strategy, the broader market took this signal of high-level capitalization and rotated it into the sector that had the most explosive upside potential: physical silver. Simultaneously, the $4.2 billion benchmark appeared in the valuation of the primary silver producers, acting as a green light for passive institutional inflows. Following the successful commencement of commercial production at its Terronera mine in Jalisco, Mexico, Endeavour Silver saw its market valuation surge to approximately $4.2 billion Canadian dollars. This was a transformational moment, as the mine is expected to process nearly 400,000 tons of ore in the coming months, solidifying the company's status as a mid-tier producer just as the metal itself entered a price discovery phase. The market re-rated these producers not based on past performance, but on the realization that they hold the only scalable reserves of a metal that is rapidly disappearing from above-ground stockpiles. First Majestic Silver also approached similar valuation metrics following high-grade discoveries at its Navidad deposit, reinforcing the idea that $4.2 billion had become the new floor for relevance in the silver mining sector. But the hidden buyer is not just financial. It is industrial, and this is where the rally becomes structural rather than speculative. If we look at the forecasts for the metal nanoparticles market, a sector critical for healthcare and advanced electronics, we see a market size projected to reach exactly $4.2 billion by 2026. This convergence is uncanny. It suggests that the industrial consumption of silver for high-tech applications has reached a critical mass where price is no longer the primary determinant of demand. Manufacturers of electronics, solar panels, and medical devices essentially became the hidden buyer, forced to pay whatever price the market dictated to keep their production lines running. This is the essence of inelastic demand. Whether silver is $30 or $70, the solar industry, which consumed roughly 140 million ounces in 2025, must buy it. The trajectory of this rally to $70 was accelerated by events that can only be described as engineered supply shocks. In mid-December, the geopolitical landscape darkened significantly when the United States ordered a complete blockade of Venezuelan oil tankers. This escalation was not merely a diplomatic spat. It disrupted global energy flows and triggered a flight to safety that disproportionately benefited precious metals. Markets hate uncertainty, and the prospect of a kinetic conflict in the Western Hemisphere sent capital fleeing from risk-on assets. Silver, often termed gold on steroids for its high volatility and safe haven properties, reacted instantly. Compounding this was a move by China that effectively weaponized the periodic table. Coinciding with Western sanctions, reports emerged that China would implement stricter export controls on silver beginning in 2026. Having spent the previous decade absorbing a vast percentage of global mine supply, China's decision to restrict exports created an immediate supply cliff for Western industry. This was a strategic constriction of the market. Global silver inventories were already at decade lows following record exports to the East, and the announcement of these controls spurred a wave of preemptive buying by Western corporations desperate to secure inventory before the gates closed. This geopolitical maneuvering forced the silver market into a state of backwardation, a rare technical anomaly where the spot price of the metal trades higher than the futures price. Backwardation is the market's way of screaming that there is a shortage of physical material right now. It signals genuine delivery stress. Industrial buyers were effectively bypassing the futures market and paying massive premiums to secure physical bars immediately, rather than trusting paper contracts that might not be honored in a supply crunch. This physical stress broke the back of the short sellers. As prices jumped, open interest in silver futures declined by over 4%. In a typical speculative rally, open interest rises as new bettors enter the market. When price rises and open interest falls, it indicates short covering, bearish traders being forced to buy back their positions to avoid insolvency. The violence of this short squeeze cannot be overstated. The Chicago Mercantile Exchange, attempting to cool the overheating market, raised margins by 10% in mid-December. In previous years, such as during the 2011 peak, margin hikes successfully crashed the price by forcing leveraged speculators to sell. But this time, the intervention failed. Prices stabilized briefly and then continued their ascent towards $70. This failure of regulatory intervention to halt the rally proved that the buyers were not weak-handed retail speculators trading on thin margins. They were well-capitalized whales, sovereign wealth funds, and industrial giants, who were buying with cash and taking delivery. The hidden buyer was simply too big to be bullied by margin hikes. Underpinning this entire engineered spike is the structural floor of industrial necessity. The narrative of the $4.2 billion buyer is anchored in the reality that the world is attempting to transition to a green and digital economy on the back of a metal that is in chronic deficit. The power module packaging market alone, which is essential for electric vehicles and renewable energy systems, is valued at $2.4 billion and growing rapidly toward that $4.2 billion benchmark. These power modules use sintered silver for thermal management in electric vehicles, a technology for which there is no viable substitute. As the automotive industry shifts toward 800-volt platforms to enable faster charging, the intensity of silver usage per vehicle increases. Furthermore, the explosion of artificial intelligence has created a new voracious consumer of silver, the data center. The physical infrastructure required to run AI models, the servers, the interconnects, the cooling systems, relies heavily on silver for its unrivaled electrical conductivity. This demand is entirely non-monetary. It does not care about interest rates or inflation data. It cares only about physics. As major tech companies race to build out their AI infrastructure, they have quietly become participants in the silver market, securing strategic stockpiles to ensure their server farms can operate. This computational silver sink has removed millions of ounces from the market, contributing to the fifth consecutive year of supply deficits, which were projected to reach 215 million ounces in 2025. The tension between this physical reality and the financial markets came to a head during the Great Rotation of December 2025. For much of the year, Bitcoin had held the title of the premier high-growth asset, trading near $100,000. However, as the year closed, a divergence occurred. Bitcoin faltered, dropping below $90,000, while silver surged. Institutional investors, reading the tea leaves of the Venezuelan blockade and the fragility of global supply chains, began to rotate capital out of digital gold and into the real thing. Strategy Inc.'s stock performance mirrored this tension. While it had successfully engineered a massive premium by leveraging Bitcoin, the market began to punish this volatility in favor of the tangible security of silver miners. The rotation was driven by a reassessment of risk. In a world of cyberattacks on energy infrastructure, like the one that paralyzed Venezuela's PDVSA, and potential internet disruptions, digital assets carry a counterparty risk that physical metals do not. A bar of silver in a vault does not require a functioning power grid to retain its value. This realization prompted sovereign wealth funds, such as Saudi Arabia's Public Investment Fund, and central banks to accelerate their accumulation of precious metals, effectively putting a floor under the price that speculators could not breach. The technical picture confirms the severity of this move. Silver's rise to 1.6 times its 200-day moving average signaled an extreme overbought condition that, in any normal market, would result in a crash. Yet the price held. The blow-off top that technicians predicted did not materialize in the traditional sense, because the sellers had simply run out of metal to sell. The Relative Strength Index, RSI, stayed in overbought territory for weeks, a hallmark of a parabolic run fueled by a fundamental shortage rather than just hype. Looking closely at the gold-to-silver ratio provides further evidence of this structural shift. Historically, this ratio has hovered around 60-1. In early 2025, it had blown out to over 105-1, suggesting silver was incredibly cheap relative to gold. By December, this ratio had compressed dramatically as silver played catch-up, outperforming gold by a factor of nearly 5 during the holiday rally. This compression is the fingerprint of a mania phase, where the cheaper, higher beta metal attracts the bulk of the speculative capital once the primary trend in gold is established. The engineered nature of this spike is thus a result of a collision between two irresistible forces: the deliberate restriction of supply by geopolitical actors like China, and the desperate, price-insensitive demand from the green energy and tech sectors. The hidden $4.2 billion buyer is the ghost in the machine, the aggregate capital of Strategy Inc.'s liquidity, the valuation of the new mining majors, and the market cap of critical industrial sectors all hitting their stride at the exact same moment. As we look toward 2026, the implications are profound. The silver market has been broken out of its decades-long slumber. The supply deficits are projected to persist, as mine production remains stagnant due to years of underinvestment. The easy silver has been mined, and recycling rates are not climbing fast enough to fill the gap. With the United States designating foreign regimes as terrorist organizations and blockading oil, the geopolitical risk premium is unlikely to vanish. This leaves the silver market in a precarious but explosive position. The engineering of the price to $70 was likely just the first phase of a broader re-rating. If the $4.2 billion capital flows were merely the opening salvo of institutional allocation, then triple-digit silver becomes not just a possibility, but a mathematical probability. The industrial world cannot function without it, and the financial world has just remembered its value. The spike was engineered, yes, but it was engineered by the undeniable reality of scarcity in a finite world. The hidden buyer has emerged, and they are not leaving until they have secured every ounce available.